Welcome to Get Rich Education. I'm your host, Keith Weinhold. Interest rates have been falling for 700 years, and your ability to borrow for 3 decades of level payment certainty for property today really is astounding. We're talking all about interest rates today, as well as a prediction about their future direction, a remarkable revelation about how scarce available property is today. How do you bring as little money as possible to the closing table when you purchase or refinance a property? All today on Get Rich Education. A lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both. Jacksonville, Florida, with 27% lower home prices than the national median and 1% higher rents, their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and appreciation for tomorrow. They often have available inventory in Jacksonville. Start at cashflowandgrowth.com. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. I'm your host, Keith Weinhold, and I'm bringing you episode 339 from a comfortable Henderson, Nevada today. If you can agree that when you think about it, your money is a store of your time and energy, an interest rate is the cost of money, so therefore then an interest rate is the cost of your time and energy. That's why it's a critical measure of your economic life. Well, this is the 50-year anniversary of the start of us having some good, reliable measures of what 30-year mortgage interest rates have been over time, because that's when Freddie Mac began tracking them in April of 1971. And by the way, do you have any idea of what rates were then? They were 7.3% back then, and 10 years later, they'd hit an all-time high of over 18%. in October of 1981. But going farther back, you've got to remember that this most popular mortgage, the 30-year fixed amortizing loan, which is like the envy of the world because the United States is about the only nation that has this advantage of 3-decade-long principal and interest payment stability, level payments over time, which is an amazing amount of certainty for you when you think about it. But the 30-year loan, that didn't appear until 1948, and they're really not believed to have become widespread until the 1950s, which was really that period of post-war prosperity for America. Before that time, we're talking about now basically the first half of the 20th century, it was common for entities like commercial banks and life insurance companies to be the one issuing mortgages. They were short-term balloon mortgages for homeowners back then. Yeah, that's how it was done. Often they had terms as short as 3 to 5 years, and then they'd be continually refinanced over and over again and never paid off, and the payments were commonly interest only. Well, those loans back then, they were also underwritten at loan-to-value ratios around 50%, which actually meant it was pretty difficult to get a home loan because you had to bring a 50% down payment and then refinance the other half. Yeah, we're talking about even for your primary residence here. Now, although the information gets more murky, arcane, and esoteric, as best we can tell, that period before and in the Great Depression, from 1920 to 1934, mortgage rates averaged somewhere around 6%. Well, let me ask you, how would you like the loan terms of 100 years ago and have those occur today? Say 50% down, a 50% loan, 6% interest rate, and then you had to refi to whatever the new rate is every 3 years. Well, that doesn't sound so great. In fact, since 80% loans became the norm decades ago, that actually then helped propel housing prices higher because when lower 20% down payments were required, well, then more people could qualify and there were more buyers to bid up home prices. If you want to take a deeper dive into some 100-year-old mortgage rate charts, I'll put a link in the show notes for you. In fact, another resource that I'll put there for you is the fact that, get this, interest rates have been falling for 700 years. Yes, there is evidence that shows that going back to the year 1311, that interest rates have indeed fallen globally over more than 7 centuries. There is evidence of interest rates used in earlier civilizations and monarchies like the French crown, the Spanish crown, merchants in modern-day Italy, in Milan and Genoa, Flanders, which is part of modern-day Belgium, the Papal States, the Habsburgs. In fact, just looking at the interest rates, again, that cost of money for a safe haven asset, okay, so these are rates that would be analogous to like today's U.S. savings bond. Rates in the 1300s century were 7.3%. In the 1400th century, they were up around 11.2%, but there from the 1400s, it pretty much fell every century thereafter. And today, it's about 1.5% when you look at the yield on the 10-year Treasury note, that comparable safe haven asset. So therefore, the cost of money, it used to be greater centuries ago. You can kind of think of it then that it was more expensive to be holding on to money that you borrowed from someone else centuries ago than it is today. It makes so much sense to be a savvy debtor today. Now, of course, these are such long-term averages over the 700-year period that your life might be 80 years long and rates could gradually go up during your lifetime because that's a short period compared to these multiple century interest rate declines like we're talking about here. If you want to take a deep dive on the 700 years of falling interest rates, that will be in the show notes for you. Before today's guest, Ridge Lending Group President Caeli Ridge and I discuss interest rates today and strategies for how you can bring less money to the closing table when buying an income property, or ways you can bring more money to the closing table and why that would make sense. There are a couple stories here first that caught my attention to share with you. Now, we like to employ the abundance mentality here. But one thing that continues to be scarce is that supply of existing homes where nationally we've fallen from 3 months of available housing supply down to an almost incomprehensible 2 months of housing supply. And a balanced market, of course, is about 5 to 6 months of supply. Well, here's one way to measure the scarcity issue that you probably never even would have complicated. A Wall Street Journal article recently reported that in America today, there are more real estate agents than there are homes for sale. Not just more prospective buyers than there are homes, not just more home wanters than there are available houses, but there are 1.4 real estate agents for every available home for sale. That is just astounding. That is one measure of how the supply of housing today is becoming about as scarce as a rare earth mineral. Now, since the onset of the pandemic allowed more people to work at home, some portion of those people which will really never return to the office or might only have to return to the office, say, 2 days a week, well, that means it's more practical than ever for people, including your tenants, to live in the distant suburbs. This means that you just have fewer people that are all commuting to work on the same schedule, on that same Monday to Friday from 8:30 a.m. to 5 p.m. with a half-hour lunch break or whatever it is. Fewer people are doing that now. And I think that this is generally good news. It changes both the density of the traffic on highways and it changes the practicality of people being able to live in more far-flung places than they did before. That suburban surge. This is really interesting. Let's learn about what's happening to rush hour traffic through NBC and their correspondents in various U.S. cities coast to coast. This is 2.5 minutes in length.
Now to the future of travel. Until the pandemic, daily rush hour traffic is one of the few guarantees in life. Last year, traffic plunged as much as 77% in some cities. And as our Jacob Ward finds, traffic is now on the uptick, but not in the ways you might think.
If you had forgotten rush hour gridlock, after a year of easy pandemic commutes, traffic now is back, but it's not the same.
Texas Department of Transportation.
Something they're tracking inside Houston's Traffic Command Center.
Well, in total levels, it's getting very close. But we think that the pattern of that travel has changed a fair amount.
Changed in that the traffic is more spread out, less concentrated to morning and evening rush hours.
With more telecommuting, more people working from home, we think that there are more trips that they're taking during the day as errands that otherwise would have happened at the beginning or at the end of the day.
Cities across the country are seeing this shift, with fewer workers heading into the office and fewer children at school. Our Houston station's traffic expert sees a difference.
In terms of speed, the gap is closing between pre-pandemic and post-pandemic speeds. Today, we're only traveling about 5 miles per hour faster than we did back in 2019.
While in Washington, D.C.,
where it used to be crammed and crowded all times of the day, and now in a lot of cases, it's wide open spaces.
But Los Angeles is basically back to its normal gridlock.
Here in Los Angeles, we have some of the most congested freeways in the country, even during the pandemic.
Here's the thing. Traffic has been back since the summer, and yet it's plateaued. On the Golden Gate Bridge, it's holding steady at about 75% of pre-pandemic levels.
What we have also noticed, however, that as we've seen fewer cars on the road, we've seen the cars actually travel a little bit faster.
In the U.S., that means collisions are down 30%, but fatality rates are up 8%. So how long will these changes last?
We're actually seeing a fair amount of evidence that a lot of the changes that we've seen are going to continue after what we could call a return to normalcy.
But to keep this going as more return to the office, experts say it requires commuters returning to public transportation and carpooling. The payoff could be worth it.
There's a lot of evidence that shows that the less time people spend in their commute, the healthier they are, the happier they are.
Jacob Ward, NBC News, San Francisco.
Material courtesy of NBC and Jose Diaz-Balart. Will rush hour become a vestige of the past? I doubt it, but we'll see. It sure looks like it will, though, be less of a phenomenon for quite a while, and that is some good news. Speaking of good news, mortgage interest rates hit all-time lows early this year. They're up off the bottom, but they're still almost incredibly low. How low are they, and what's their future direction? That's straight ahead. Today, we're talking to the president and CEO of Ridge Lending Group. She is herself a real estate investor of more than 20 years. She's held as many as 42 investment properties across the United States at one time, and she's really made contributions to our industry like few ever have or will, with tens of thousands of real estate investors and homeowners all over the country. She's actually helped more families realize their dreams of owning income property than any other mortgage lender in the entire nation. Welcome back to GRE, Caeli Ridge.
Whoop, whoop. Hi, Keith. Thank you so much for having me. I love being on this show. Hello, GRE scholars. Happy to be here today.
All right. They've graduated to scholars by now because you've been schooling them for quite a while here on the show, Caeli. And interestingly, something really newsworthy took place a few weeks ago. That's when Fannie Mae tightened standards on investment properties. They had a 7% limit for single-family investment properties and second homes that was mandated there. And when I first read the article from Housing Wire, I didn't know what they meant, that 7% limit. So tell us more about that. Does that 7% limit pertain to the amount of their funding pot? That's only now 7% maximum that can go into single-family investment properties and second homes. Tell us more.
That is correct. And what I thought I might do is I'm going to read a snippet straight from the publication that we received a couple weeks ago from Fannie, and then I'll kind of get into the definition behind some of the language. Yeah. So here we go, guys. Recent amendments to our senior preferred stock purchase agreement with the Treasury impose additional risk criteria on the loans we acquire. One of those restrictions is a 7% limit on our acquisition of single-family mortgage loans secured by second home and investment properties. So let's break that down a little bit. This has to do with Fannie Freddie's senior preferred stock purchase agreement with the Treasury. So the United States Treasury right now has been purchasing for the last year massive amounts of mortgage-backed securities from Fannie Freddie, ensuring that we keep interest rates low amidst the pandemic, et cetera. So within that preferred stock agreement, senior preferred stock agreement to be specific, they have put a restriction and limited the total acquisition of second home and investment to 7% per aggregator. Okay, so that's an important distinction, I think. So for example, me personally, I had 100 loans that I am reselling to one aggregator or one investor once they've all funded. And of that 100, only 7 of them could be for investment and or second home. That's kind of how they're looking at it, because there's so many tens of millions and thousands of mortgages being done. The number 7% I don't think is going to be as concerning as it may sound to most people. But there's a second part to this that is impactful. What the impact really of that means is it's going to increase interest rates for investment property and second home. Now, anybody that's been kind of paying attention to the markets and watching interest rates over the last 4 or 5 weeks have noticed there's been an uptick. Rates have increased. Inflationary concerns seem to be the primary culprit there. But once we got that announcement, we saw an additional increase to rates specifically for investment property. And the reason for it is, as a result of the announcement, those investors, those aggregators that I had mentioned, that we as the lender will sell these loans back to, have increased what are called LPAs. This stands for loan price adjustment to investment properties. Let me give you an example. Let's say before this announcement came out, an LPA for investment property was 2% versus maybe a primary residence, it's 1%. Now, this is not to rate, this is a price adjustment. If we were at 2% LPA before the announcement, after the announcement, I'm finding that we're roughly about 3.5% LPA. So again, it's not percentage to percentage from LPA to rate, but that increase in the loan price adjustment has taken already increasing rates a little bit higher. And we'll go into that, I think, a little bit about specifically where are rates today.
Okay, so you are talking about a negative impact to interest rates as far as this creating interest rates to be higher.
It was a double whammy. Yeah, we were seeing rates raise, and then this announcement came out. We were not expecting it. It was a blindside for sure. But both of those things, rising interest rates for inflation and this announcement, kind of created some extra heartburn for some of us in rising interest rates. But I think that toward the end of this conversation, when we really plug in the numbers, I think the listeners will find that it's not going to be as devastating or damaging as the psychology of what they're hearing right now might make them think otherwise.
When does this become effective?
Immediately. It's effective now.
We'll talk about that in a moment. I know recently there's also been some changes imposed to the QM rules, QM meaning qualified mortgage, and we generally think of those as those best rates and terms that a single person can get on up to 10 1 to 4 unit properties and a married couple up to 20. Tell us about those.
This was some good news on the investment property front. So the QM rules, in this case, specifically having to do with the ability to repay a mortgage, and more specifically, the debt to income ratio threshold has been leveled at a certain, 50% since the 08-09 crash. That was put into place via what we called a QM patch. The QM patch was set to expire January of this year. I think it was January 21st, actually. A few months before that, they extended it to July of this year. And a few weeks ago, we got the newest announcement saying that QM, the way it's been written since 08-09, is going to stay into effect until October of 2022. So we have more time to live under the current rules before they make any significant changes. That's good news.
Okay, that's good. Something that's constant for a while.
Yes.
We touched on interest rates before, so we know that interest rates hit record lows, all-time record lows for as long as Freddie Mac has been tracking the rate, which is about 50 years now. In fact, Freddie Mac told us that the owner-occupied rate hit 2.65% for a 30-year loan 3 months ago. It's been up somewhat since then. Tell us more about those interest rate changes.
So for interest rates, obviously, that's a primary topic of discussion that I have very often with our investor clients. And I want to take a minute and put it into perspective. Again, there's a large part of psychology that plays into interest rates and when they go up or when they go down. And I think that the average individual is not well versed enough in the math of it to be able to really identify and see it for what it's worth. Let's talk about specifics. Let's say 5 weeks ago, we were locking interest rates at 3.5% based on the following criteria. We'll call it a purchase of an investment property, single family residence, $150,000 purchase price with 20% down. We're going to assume a 760 or greater credit score. That's kind of the profile that we'll use to give an example quote on. Okay. So if we were at 3.5% 5 weeks ago, we are locking that particular scenario today at 4.25. In the minds of most people that hear that 0.75 of a percentage point jump, they're going to think, wow, that's huge. But when you put it into perspective, the difference in payments between 3.5 and 4.75, well, I'll give it to you this way. On this loan level, 120,000, every 1/8 of a percentage point increase or change, either way, above or below, is going to equal $8 a month. So put another way, between 3.5 or 3.625, you're increasing the payment by $8. Let's see if I can quickly figure out the difference between the payments. So $590 would be the principal and interest payment using 4.25 on 120,000. At 4%, that's $573, right? You can kind of see that approximate 8% difference between the 1/8 of a percentage point.
The $8 difference, yeah.
So all in, if I'm doing my math correctly, I am in finance, I can't do mental math, I had to cheat and use my calculator. It looks like the payment difference total is going to be about $56 a month between the 3.5 and the 4.25. And while my next statement is pretty general, I tell everybody, of course, we want to yield the lowest possible interest rate for our investment. I think everybody agrees that $56 is not going to break the investment or decrease the yield in a way that it results in not purchasing or not refinancing if you're pulling cash out or whatever the circumstances are.
So the interest rate obviously matters. We're all after the lowest interest rate we can, but I think you're saying put things in perspective. For a $120K loan amount, every 1/8 of a percent change is about an $8 change in payment, and that comes out to something like $56 for interest rates that go from 3.5% up to 4.25% on a $120K loan amount.
Perfect. You did it much better than I did, yes.
I had the benefit of listening to you describe it. Interestingly, Caeli, when it comes to one having an interest in getting a lower interest rate, before that borrower comes to the table and closes, they can agree to do something called paying discount points, paying points up front at the table. And some borrowers wonder, now, should I pay those discount points or not? And I think of discount points essentially as being prepaid interest. That's really what they are. So can you tell us about some of the pros and cons of one paying discount points and therefore giving the borrower the ability to buy down their interest rate over time?
That's actually a very good way of defining it, Keith, paying the interest up front. So general rule of thumb is, for me, well, the first question I'm going to ask somebody when they're looking at paying extra points to buy the rate lower is how long are they going to keep this property? Approximately. There's probably not a hard and fast, but let's say that they're going to keep it for at least 5 years is the expectation. The math would be simple. If you look at the payment savings, principal and interest savings, by paying these extra points and reducing the interest rate, taking the monthly payment savings and dividing it by the dollar amount of the points will yield the number of months it takes to recapture cost versus savings. And within that scenario or that formula, it should be able to define for the individual if it makes sense to buy the rate down by X. If they know that they're going to have the property for 5 years or 60 months, but that math formula that they just plugged in says that they'll recapture the cost versus savings in 36 months, clearly that's a win-win, right? They want to go ahead and exercise the discount point. The other thing that I would mention is that points paid on an investment transaction are tax deductible. So while that's secondary, it's usually something that I want to include in the conversation and make sure that they're considering.
That's a good point. So to give an example, and hey, this is quite a real life example because I'm actually doing some refinancings with Ridge right now. But say I or a borrower came to the table before they got there, they had an opportunity to pay $2,000, say, to buy down their interest rate so far that it would save them $50 per month in a reduced payment due to that lower interest rate. Well, with $2,000 in prepaid interest up front, with that lowering one's payment by $50, therefore it would take $2,000 divided by 50, 40 months for that borrower to break even. So thereafter, if we'd say that they aren't getting any rate of return on that money otherwise, after the 40-month mark is where they begin to go in the black and begin to profit from the arrangement of paying points up front.
Perfect, yes. And remember, too, like I said, there's the discount points, they're tax deductible. But remember, all along, that savings, that $50 a month, is realized passive income that you're going to be collecting every month for that 3.3 years or 40 months.
That's true. And I guess if one thought, though, however, that rates could fall so low that they might want to refinance before that 40-month period came up, that might be another thing for them to think about before they prepaid their interest with discount points up front.
Certainly, absolutely. The tricky part about that is having the crystal ball, right? And not knowing where rates are going to be and trying to predict, whether I refinance now and pay discount points and or refinance again later if rates come down. There would be a mathematical equation that we would do with them that can define specifically the pros and cons of it.
We're talking about the borrower to have the ability to pay more at the closing table if they want to in order to reduce their interest rate, hence their monthly payment over time. Oppositely, what one could do if they want to conserve money and bring little or nothing to the closing table is potentially have the option of rolling some of their closing costs into the loan amount, which is personally something I favor doing. And I like to go ahead and do that because that way I basically get to amortize my closing costs over time into the loan amount at a very low interest rate. Often it's tax deductible as well. So tell us about that, the circumstances in which one can roll some of their closing costs into the loan amount.
Well, I couldn't agree more. I think that whenever the opportunity presents itself and someone is deciding between coming out of pocket for the closing costs versus adding it to the loan and rolling it in, as you described, 100 times out of 100, I'm always going to tell them to roll it into the loan. The circumstances that would approve that or that would make that feasible, as long as there's enough equity in the property that will account for, say, a maximum loan to value or LTV threshold of what the product will allow for. And that means that we can include payoff, the existing mortgage balance, plus the closing costs, and keep that loan to value at its threshold without going over, obviously. Always, 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 I'm going to recommend to go ahead and roll those closing costs in. When you do the math between, and let's just say, just for round numbers, closing costs, taxes, insurance, everything are $5,000. And our loan amount without the closing costs is $80,000. When we add the loan or the closing costs in, it's $85,000. The difference in monthly principal and interest between 80 and 85 is literally dollars a month. You'd be better served to keep that $5,000 and use it for some other return, potentially add it to the mix for another purchase or some investment.
Right. And when you talk about how that payment difference, when you say it would only be dollars a month, I mean, you're talking about something oftentimes like $10 a month or less at a loan amount like that. So why not just keep the $5,000 in your pocket?
Exactly. And 10 is probably very generous. Usually that math is $5, maybe $6 a month difference.
So I would imagine that one's ability to go ahead and roll some of their closing costs into the loan amount, that oftentimes wouldn't work as well for new purchases because you're probably going at 80% loan to value. And if you roll some of the loan costs into the loan, you might go up to 82% LTV and that wouldn't work. So therefore, it's probably more likely that one can roll their closing costs into the loan amount if they're doing a refinancing rather than a new purchase.
Yes, that's exactly right. In fact, technically speaking, underwriting guidelines, you can't roll closing costs in on a purchase, right? So if you're purchasing a property and you're putting 20% down, we as the lender are going to fund 80% of whatever the purchase price is. There isn't that room or availability of equity that would allow you to do so. However, since we're talking about this, I might just offer a quick idea for investors to potentially use. Now, I realize this is a seller's market in many cases, but there is kind of a hack that we can use or that I have described to my clients over the years that might allow them to, quote unquote, roll closing costs in. On an investment transaction, according to Fannie Freddie guidelines specifically, they say that we can have the seller pay a maximum 2% of the buyer's closing costs based on the purchase price. So if it's a $100,000 purchase and you can negotiate for the seller to pay 2% towards your closing costs, that's $2,000 that you kind of rolled in sort of. Now you're not financing it in, but you've negotiated with the seller and that's what can happen. Now, if the seller is not willing to do this, one of the things that can actually transpire is you could offer, instead of $100,000 for the property, you could say, okay, Mr. Seller, I'd like to pay you $102,000 for this property.
Yeah.
Now credit me my 2%. He or she should have no problems in doing this. They're still going to net the $100,000 that they want. In this example, you kind of have financed in 2% or that $2,000. The difference in your payment between a purchase price of $102,000 at 80% or $100,000 at 80% is, again, $2 or $3 a month.
Pretty negligible.
Yeah. Now, this is the key to all of this. Obviously, if you had to negotiate and pay a little bit higher in price point, in our example, $102,000, the appraisal must come in at the 102 to make the deal work. So that'll be conversations that you would have to have with your agents and or your sellers, et cetera.
We're getting some great guidance here about how you can, if you're interested in it, keep more money in your pocket rather than bringing it to closing, if that's what you choose to do. Personally, it's a strategy that I've often favored. And with historically low interest rates and the ability to borrow more at those low rates, which is effectively what you're doing when you bring less money to the closing table, that's why it's more advantageous now than it was previously. You're listening to Get Rich Education. We're coming back with more with Caeli Ridge. I'm your host, Keith Weinhold. This is Get Rich Education. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They've provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to fourplexes. They're the number one lender for both beginners and veterans. Start your pre-qualification, chat with President Caeli Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com. You know, starting in real estate seems hard for some. Even experienced investors can find it difficult to achieve the success that they had hoped for. What if there was one small change everyone could make that would solve these challenges? Allie Boone offers a book that really no one else has. It's an easy-to-understand glimpse into the real estate investing industry and your mindset. It's life lessons on hacking your mind before you hack your wallet. Her book to grab on Amazon is called Not Your How-To Guide to Real Estate Investing.
This is Rich Dad, Poor Dad author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Ridge Lending Group President and CEO Caeli Ridge. We've been talking about what's happening in the mortgage market today and what's happening with interest rates. Caeli, economic forecasters often get these things wrong. What's going to happen with inflation? What's going to happen with interest rates? But if you can speak to us about what you believe the potential future direction of interest rates is, at the least, whether the forecast becomes true or not, people will have a better understanding of what goes into it and how the pressure on the 10-year Treasury note affects 30-year and 15-year mortgage rates. Tell us more about the future direction of interest rates.
I will agree with you that some very smart people, way smarter than me, get the predictions of the long-term rates wrong all the time.
They get it wrong all the time.
All the time. I've been wrong more times than I care to admit. However, here's my crystal ball. I'll bring that back into play. I do believe that over the next 30, 60, 90, we'll continue to see rates rise, even if it's just slightly. I don't think we're going to see anything drastic. But my prediction for the future, I'm going to say fourth quarter sometime. I think that we are going to see rates come back down a little bit with the, wide access to the vaccine, some of that herd immunity. I think that's going to create supply chains are going to start opening up and things of that nature. Recession is looming with the amount of debt clearly that we have incurred over the last year. There's no way that rates will stay high. So I really think that those factors predominantly are going to be the result of lower interest rates once again come, September-ish is my best guess.
Some people wonder, can rates really go lower than they've ever been? I mentioned 3 months ago they bottomed out for a 30-year owner-occupied rate at 2.65%. And we know over the past 5 to 10 years, so many people have been wrong because they've said, oh, interest rates couldn't possibly go lower, and then they go lower again. So my question is it possible for interest rates to ever go lower than that all-time low that was hit 3 months ago?
I'm going to say no. I don't think we're going to get back to that place. Certainly, there are infinite variables that could make me a liar, but I think that the odds are extremely low that we'll ever get back into that zone of interest rates. I think we're lucky that if we shave a quarter, 3/8, maybe even a half a point to where they are today, later in the year and through 2022, maybe into 2023, we're going to be in a great place. But I always want to take a minute and remind folks that psychology thing of interest rates, remember, largely dependent on the loan size, that 1/8 of a point in rate, quarter point, half a point, full percentage point is not going to be the make or break of the investment. And also, very important to recall that when rates rise, what happens to our rents? They will rise with them. They will not be simultaneous, right? They're going to come at a slower pace in catching up, but interest rates rise, and as investors, we will notice that our rents will keep up with them.
Right. There is that correlation. If interest rates rise, rents generally rise. There is some lag time there. And the prevailing notion there being when interest rates rise, now that entry-level home is less affordable for that renter that was a prospective home buyer. Therefore, they need to stay a renter. Therefore, that increases rental demand and rental amounts because mortgage interest rates went higher. It's a constraint on that prospective first-time home buyer. Historically, if interest rates go higher, like they have been lately, this often helps crimp the amount of housing supply that's out there because a lot of people want to stay in their home if they already have a low rate. They're less likely to want to move out because they lose that low rate. So therefore, that puts less supply on the market because you want to stay home and keep your low 3 or 4% mortgage interest rate. You don't want to leave your home because you leave your rate behind. That means less supply comes onto the market. So oftentimes prices can rise even in a rising interest rate environment. Well, Caeli, you've been giving great guidance to our audience for so many years here on the show. You're based in Portland, Oregon, but of course you serve investors in most U.S. states, especially those investor advantage states. So let our audience know more about how they can connect with you, just like I have, and get their income property loans done through Ridge.
So you can reach us in a few different ways. We would love you to go to our website, www.ridgelendinggroup.com. You can apply right there online. You can email us at info@ridgelendinggroup.com, or you can call us toll-free 855-747-4343. 855-74-RIDGE is an easy way to remember that, and we look forward to speaking with you.
Caeli, it's been informative as always. Thanks so much for coming back onto the show.
Thanks, Keith.
Yeah, great clear material from Caeli, as always here, because she and her company deal in income property loans. That's their specialty. They aren't going to be thrown off by the fact that, say, you're buying a turnkey property where some lenders get concerned about the interim owner's seasoning period while they were rehabbing your property or anything like that. You've just got to be mindful that they, or any company, they're going to require you to supply them with a good amount of loan documentation in underwriting. And hey, before I buy or refinance a property, I first just say to myself before I do it that I think it's going to be a full day's work when all of my time is added up. And there will be emails from various people in your inbox as your loan moves along, and that your new purchase or your refinance is going to be to your financial advantage by X dollars per month or per year going forward. Just tell yourself that and be sure that that amount is worth, say, 1 day of your time in getting your loan officer and your processor whatever documents they need. I think that mindset really helps. And hey, when you're getting started on your next income property loan or refinance at Ridge Lending Group, you might just tell them, thanks for having Caeli Ridge tirelessly contribute to the show here for so many years. On the next episode, an economist and I will have what might turn into a bit of a debate here. I don't know, as he's going to tell us about how primary residence owners build wealth through home ownership. That should be some really good stuff. I'm Keith Weinhold, and I'll be back next week right here to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.